Okay, hi everybody. How are you? I hope everything is going well by your side and hope that you're staying safe at your home. What I want to say for you that we are going to continue with you the rest of the tutorials throughout the remaining part of the semester from tutorial 4 to tutorial 11. Today we are going to start with tutorial 4. Actually, last time when we met with each other, we have started talking about the accounting receivables in chapter 9, and we made a quick recap, of course, saying that, of course, you know what accounts receivable is when the company perform a service on credit or sell some products on credit, which means the company will not receive any cash on spot. However, the cash will be received in the future. And of course, you know that the accounts receivable is a type of current asset. We have said that any company determined to deal with transactions on credit should know that it will incur some costs related to this decision, which is that some portion of the money or the cash the company is waiting to receive in the future shall not be collected all. This amount of money that is not collected is called bad debt expense, and this is the expense or the cost that the company will incur since the company is dealing with or is allowing customers to buy products on credit. Okay, actually, since this happens, the company should determine how to account for this bad debt expense. So there are two methods actually to account for this bad debt expense that we'll discuss thoroughly in few minutes, which are the direct write-off and the allowance method. For now, we have just spoken last time about the credit card transactions, in which the company is allowing the customers to purchase products using the credit card of a certain bank. So the bank is acting as an intermediary in which the bank will collect the cash later on from the customers in the future. However, the company takes its cash immediately. So the bank, of course, will not do this service for the company for free. The bank will charge the company for this service, will charge a certain fee. And that's what we already solved on last time when we solved an exercise saying that there is a certain bank determining a certain percentage to take it as the fee or the charge for doing the service for the company. Okay, this is what we have already done last time. What we were going to make today is also credit card transactions, however, using the store credit card, in which the company issues a credit card with its name, and the company and the customer is using the credit card of the store of the company. So let's see the first exercise for today, says on store credit card. The first exercise says that Z-Mart uses the perpetual inventory system and allows customers to use the Z-Mart store credit card in charging purchases. Z-Mart assesses a per month interest fee for any unpaid balance on its store credit card at each month's end. Required prepare journal entries to record the following selected credit card transactions of Z-Mart. Number 1. April 31st, Z-Mart sold merchandise for $1,000 that had cost $650 and accepted the customer's Z-Mart store credit card. Number 2, May 31st, Z-Mart recorded $4 of interest earned from its store credit card as of this month's end. Okay, let's start with the first transaction. Z-Mart sold merchandise for $1,000 that had cost $650 and accepted the customer's Z-Mart store credit card. Why are we having these two different numbers? Actually, because as it's stated in the problem or in the exercise, that Z-Mart uses a perpetual inventory system. Perpetual inventory system. And since the company is using perpetual inventory system, this means that when we have any sale transaction, we should record or we should make two entries. One entry for the recording the revenue, the sale I mean, and the other entry for recording the cost of goods sold. That's why we're having these two different numbers for the two entries we are going to make now. Okay. So the entry will be debit accounts receivable and credit sales with $1,000. This to record the entry. However, we need another entry for recording the cost of goods sold, debit cost of goods sold and current merchandise inventory using the other number, which is the cost, the 650. Okay. So this entry is like we say that the company sell products for on credit. Sell products on credit. Okay. What about the second transaction? May 31st, Zedmart recorded $4 of interest earned from its store credit card as of this month's end. Here, the company charges the customer for a certain fee for every delay in paying the cash for the company. So here the company charges the customer $4 as interest. For the company, this interest is considered revenue, which is an interest revenue. So the entry will be as follows: debit accounts receivable and credit interest revenue. Because the company has not received any cash from the customer now, it will receive the cash in the future. The 1,000 along with the interest that the company charged for the customer for paying later on and not paying now for the same transaction. So it's debit accounts receivable and credit interest revenue by $4. Okay. Let's move to the second part of this chapter, which I think is the most important part, talking about how to account for the bad debt expense, as I've just said for you from a few minutes. When I say that, since the company determines to deal with, say, transactions on credit, it should put into consideration that some portion of the cash that the company is waiting to receive in the future shall not be collected all. So the amount that is not collected is considered as bad debt expense. This is the cost that the company incur for selling products on credit. Why the company make this? Sell products on credit to motivate the sales, to increase the sales, as we have just said last time. To increase the sales. Okay. So let's see the first method that the company can use to account for the bad debts, which is called the direct write-off method. In the direct write-off method, the company is sure that this amount of money will not be collected. What do I mean by making sure that the payment date comes and the customer did not show up, did not pay the amount of cash that he owed to the company? So by this, I'm sure that this amount of money is not going to be collected. I'm going to use the direct write-off method. I'm going to write off this amount of money. Okay. This method actually has a drawback, and we'll see what is the drawback while solving now. Let's start with the exercise. Exercise 2, Dexter Company applies the direct write-off method in accounting for uncollectible accounts. Prepare journal entries to record the following selected transactions of Dexter. Required prepared journal entries to record the following transactions. March 11th, Dexter determined that it cannot collect $45,000 of its accounts receivable from its customer, Lear Company. Let's see what will be the entry. Okay, the entry will be as follows: debit bad debt expense and credit accounts receivable. In this entry, I'm just recording that I want to write out this amount of money because the date of payment came and the customer did not show up, did not pay the amount for the company. So I debit the bad debt expense. You know that any expense has a debit nature, so it's debit bad debt expense, and this is the cost that we incur on condition that the company accepts, the condition the company accepts as long as the company sell products on credit. So the cost the company incur is that some portion, or a certain portion of money will not be collected. This is called bad debt expense. So we debit the bad debt expense and we credit accounts receivable. Why credit accounts receivable? Because we cannot leave the accounts receivable recorded as 45,000. Because anyone who's going to have a look at my financial statements, balance sheet for example, will understand that I'm waiting for this 45,000 to be received in the future. However, I'm not, because the customer did not pay for me the amount on the payment day. So I'm sure that this amount of money will not be collected. That's why I'm writing up this amount of money. Okay. Moving to the second transaction, March 29th, your company unexpectedly pays its account in full to Dexter company. Dexter records its recovery of this bad debt. Actually, in this transaction, what happened that the customer, for any reason, comes to the company and paid the amount. Maybe his financial position has improved. He doesn't want his reputation to be affected negatively in the market, so he comes to the company and pays his amount in full. So this is a recovery for the bad debt. What we are going to record for the recovery of bad debt, actually we need to record two entries. One entry to reverse what has already happened on the date of writing of this amount of money, and the other entry just to record the collection of cash. Okay. So the entry will be debit accounts receivable and credit bad debt expense. This entry just reversing what has already been recorded for writing of this amount of money. And then the other entry for the collection of cash, debit cash and credit accounts receivable. What I want to say here, the drawback before moving to the another method, allowance method, the drawback for the direct write-off method is that, for example, assume that there is a sale that already happened in 2019. And then the payment date for this sale is in 2020. So in 2020, when the customer did not show up and did not pay the amount he owed for the company is going to record bad debt expense. So there is an expense recorded in 2020 which is related to revenue that has already been generated, that already happened in 2019, which makes this matching, and this is a very important principle in accounting, which is the matching principle. That's why the allowance method appears to overcome this drawback for the direct write-off method. Okay, moving to the next method, which is the allowance method. Actually, in the allowance method, it's based on estimation, which means that on the date of the sale transaction, just record another entry recording or estimating how much amount of money expecting not to collect from my customers in the future. This estimation actually is based on the manager's experience. For example, from their experience with dealing with this customer, they expect that this customer will not pay its amount in full. Some students ask me here why we are dealing with this customer. Actually, maybe this is out of the accounting perspective. It's none of our business. Maybe because we have some benefits from dealing with this customer. Whatever the reason is, actually, what I'm concerned with is our accounting job here. So how this estimation is done, actually using different methods. There's percent of sales method, just saying that certain percentage of the account, the annual credit sales, for example, like different percent will not be collected. Or the percent of accounts receivable, having a certain percentage and the amount of accounts receivable, and just we multiply. Also, there is another method called aging for accounts receivable. I do not say it as a separate method because it's the same concept, it's the same idea of the percent of accounts receivable. However, the idea for the new idea for the aging of accounts receivable is the customers are divided into categories. For example, we have category A, this group of customers in which 90 days have passed, 90 days due, for example, 90 days passed after the payment date, and so on. And for each category, we have a certain percentage determined from the accounts receivable, and so on. Okay, we'll discuss these other methods already in the next tutorial, inshallah. However, now we are concerned with the percent of sales method in this exercise. Saying that at year-end December 31st, Chan Company estimates bad debt as 0.5% of its annual credit sales of $975,000. Chan records its bad debt expense for that estimate. On following February 1, Chan decides that the $580 account of P Park is uncollectible and writes it off as a bad debt. On June 5, Park unexpectedly paid the amount previously written. The court prepared the journal entries of Chan to record the transactions and events of December 31st, February 1st, and Jan 5. Okay, let's start with December 31st. In December 31st, what happens? Just I'm estimating that 0.5% of the annual credit sales were not going to be collected in the future. So the entry will be as follows: debit bad debt expense and credit allowance for doubtful accounts. Why did I credit the allowance for doubtful accounts and not credit the accounts receivable? First of all, for debiting the bad debt expense, we agreed with the company as long as it's dealing with sale transactions on credit, it should put into consideration there is a cost increase in this regard. So this cost is called bad debt expense. That's why, and any expense is debit, that's why I debit the bad debt expense. For credit, the allowance for doubtful accounts, why did not credit the accounts receivable? Because I cannot say now that I'm sure that this amount of money will not be collected. I'm just estimating now. The payment date has not come yet. So I'm just saying I'm doubting, I'm estimating this amount not to be collected, I'm expecting this amount of money not to be collected. And this allowance for doubtful accounts is a contra asset account. That's why it's credit. It has nature opposite than the asset. The same as the accumulated depreciation. If you remember, we said that it's considered as a contra asset, so it has a credit nature, and in the balance sheet it appears with a negative sign. When we said for the plant assets, for example, you have the machine less the accumulated depreciation to arrive to the net book value. Also here for the accounts receivable, for example, we have accounts receivable of $100,000. That's allowance for doubtful debts with the negative sign less because it's a contra asset. Gives me $99,000, for example, net realizable value, which means this amount I'm expecting to realize from my customers in the future. Okay, moving to the second entry for February 1. Okay. Actually, on February 1, the entry will be debit allowance for doubtful accounts and credit accounts receivable. Because here we are sure the payment date has come, and we are sure that this amount of money will not be collected, which means that our estimation concerning this amount of money is correct. So I debit the allowance for doubtful accounts, I decrease the allowance, since now I'm not doubting, I'm sure that they are not going to be collected. And we credit the accounts receivable since I'm sure. Okay, let's move to the last transaction. On fifth park unexpected paid the amount previously written off, which means that the customer came to me after I have already written off this amount of money, as it will be uncollectible. He came and gave to me this amount of money for any reason. I just said maybe his financial position improved whatsoever. What's important for me now that I need to record this recovery of the bad debt. In the recovery for the bad debt, I need to make two entries actually, as I've just said. One entry to reverse what has already happened on the date of the writing of this amount, and the other entry to record the collection of cash. Okay, so the first entry will be debit accounts receivable, credit allowance for doubtful accounts, and the other entry on the 5th for the collection of cash, debit cash, credit accounts receivable. So I want you always to remember that when we are recording for the recovery of bad debts, we need to make two entries. One entry for reversing what has already been recorded for writing of this amount, and the other entry for the collection of cash. Someone may ask me why we debit the accounts receivable and then we credit it, because I cannot credit it, I cannot decrease it without returning back to increase it before I decrease it, to be able to credit at the end the accounts receivable when I already collected the cash. Okay, that's it for this tutorial 4. Hope it was beneficial for you. Thank you.